Welcome to our deep dive into balance sheets, one of the fundamental financial statements. Today, we'll unravel the mysteries behind balance sheets, and by the end of this video, you'll be able to create, analyze, and understand balance sheets like a pro. Let's start by understanding what a balance sheet is. A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It details what a company owns and the value of the shareholders' equity. The balance sheet follows the simple equation: assets equals liabilities plus shareholders' equity. Now, let's break down the components of a balance sheet. Assets are everything that a company owns and can provide future economic benefits. They are usually classified into current and non-current assets. Liabilities represent what the company owes to others. These are also classified into current and non-current liabilities. Shareholders' equity is the residual interest in the assets of the entity after deducting liabilities. It includes common stock, retained earnings, and additional paid-in capital. Let's explore an example. Suppose company ABC has $1 million in assets, $400,000 in liabilities, and $600,000 in shareholders' equity. As per our equation, assets equals liabilities plus shareholders' equity, confirming $1 million equals $400,000 plus $600,000. Question time. If a company has $800,000 in assets and $200,000 in liabilities, what is its shareholders' equity? Pause the video and think about it. The answer is $600,000. Using the balance sheet equation, shareholders' equity equals assets, liabilities, hence $800,000 to $200,000 equals $600,000. Let's go deeper into analyzing balance sheets. The first step is to calculate and understand certain key financial ratios. One important ratio is the current ratio, which is calculated as current assets divided by current liabilities. This ratio helps in assessing the company's ability to pay short-term obligations. For example, if company XYZ has $500,000 in current assets and $250,000 in current liabilities, its current ratio would be 2. Another useful ratio is the debt-to-equity ratio, calculated as total liabilities divided by shareholders' equity, indicating the proportion of equity and debt used to finance the company's assets. If company ABC has $400,000 in total liabilities and $600,000 in shareholders' equity, its debt-to-equity ratio would be 0.67. Let's take a moment to review these key financial ratios with another quiz. If a company has $900,000 in assets, $300,000 in current liabilities, and $600,000 in shareholders' equity, what is its current ratio and debt-to-equity ratio? Pause the video and calculate. The current ratio is 3. Current assets are assumed to be equal to total assets minus non-current assets. Here we assume all assets are current, calculated as $900,000/$300,000. The debt-to-equity ratio is 0.5, calculated as $300,000/$600,000. Interpreting these numbers helps in making informed decisions. A current ratio of 3 suggests a strong liquidity position, while a debt-to-equity ratio of 0.5 indicates moderate leverage and financial stability. Here's a pro tip: always compare these ratios over multiple periods to discern trends. For instance, if the debt-to-equity ratio is consistently increasing, it might indicate rising financial risk. Another aspect is vertical and horizontal analysis. Vertical analysis involves using percentages to compare individual components of financial statements to a total figure within the same period, such as comparing current assets to total assets. Horizontal analysis, on the other hand, involves comparing financial data across different periods to identify trends and examine growth patterns. Let's visualize a horizontal analysis. Suppose company ABC's total assets were $1 million last year and $1,200,000 this year. This produces a 20% increase. Congratulations on making it this far. By now, you should have a solid understanding of balance sheets, including their components, the crucial equations involved, and important ratios for analysis. Remember, a balance sheet is more than just numbers. It's a powerful tool to assess the financial health and stability of a company. Keep practicing, and don't hesitate to reach out with any questions. Thank you for watching. Don't forget to subscribe to our channel for more finance tutorials. See you in the next video.